If you bought an Apple stock 18 months ago, you made $0. Nothing. A flat line. Meanwhile, Apple was busy generating the biggest quarterly profit in human history. They are worth $4.45 trillion, larger than the entire economy of UK, France, or India. So why is the stock for the most profitable company on earth sitting dead sideways? It's not a scandal, it's not a drop in sales, it's not an iPhone sales crash, and it's something much darker. Apple has officially run into the wall of diminishing returns. They've outgrown growth itself, and the extreme length Apple is going to right now just to survive it is going to rewrite how you buy tech. To understand why Wall Street is ghosting Apple, you have to look at the numbers, because honestly, they sound like a joke. In just 3 months, Apple pulls in roughly $25 to $30 billion in net profit. That means every 90 days, Apple generates enough liquid cash to buy Spotify or eBay outright. They are sitting on $150 billion in cash reserves. If Tim Cook decided to shut down every iPhone factory tomorrow, Apple could stick that cash into basic government bonds and pocket $7 billion a year, doing absolutely nothing. They are basically a massive hedge fund that happens to make smartphones and laptops on the side. So why isn't the stock skyrocketing? Because in economics, there is a fundamental rule called the law of diminishing returns. When you are a small company, spending $1 million on R&D might double your sales. When you are Apple, spending $10 billion on a slightly better camera or a thinner screen barely moves the needle. You are throwing massive amounts of money at tiny marginal gains. If you earn $50,000 a year, getting a 20% raise means finding an extra $10,000. You get a promotion, you hit your target, you are satisfied. If Apple wants to grow by 20%, they have to find $20 billion in brand new profits every single year. This is not something you get by improving operations. You have to invent an entire Fortune 100 company out of thin air every 12 months. They've hit the limits of traditional growth. This brings us to Apple's biggest problem. They've run out of humans. There are over 2 billion active Apple devices on Earth right now. They already own virtually every high-income consumer who can afford a flagship phone. And because of diminishing returns, making the iPhone 16 or 17 twice as powerful doesn't make people buy them twice as fast. The hardware is already good enough. So how does Apple fight this ceiling? Look at what they are quietly rolling out recently. Their new hardware leasing and subscription plans. Instead of begging you to drop $1,000 to $1,200 on a brand new phone every year, Apple wants to sign you up for a monthly payment plan. You pay a lower fee every month for 2 or 3 years, hand the device back, and automatically upgrade to the next one. On the surface, it looks like a nice discount program for consumers. But look at what Apple is actually doing here. They are pivoting from selling gadgets to collecting monthly rent. They've realized the hardware sales have hit a wall. So instead of hoping you buy a new phone, they are turning themselves into a digital landlord. You won't ever truly own your tech. You just pay Apple a subscription fee to use it for the rest of your life. Option A, selling cheap $200 phones destroys their luxury brand and destroys their profit margins. Option B, inventing another product as massive as the iPhone is mathematically impossible. The Vision Pro is impressive, but at $3,500 is a niche luxury, not a mass market savior. So if you can't find new customers, you turn your old customers into monthly rent payments. Since Apple can't easily grow its sales by 20% a year anymore, they've turned to financial engineering, stock buybacks. Every single year, Apple takes nearly $100 billion in spare cash and uses it to buy back and destroy its own shares. Here is why it matters to investors. Imagine a pizza cut into 10 slices. If the shop throws away 2 of its slices, your remaining slice instantly represents a larger percentage of the total share. That's what Apple is doing. The business isn't expanding wildly because there are fewer total shares in existence. Each remaining share gets a bigger slice of the profit pie. It keeps the stock price stable, but it also sends a clear message to the investor market, which is Wall Street. We have so much cash, but we've hit such a hard diminishing returns internally that we don't have enough good projects to spend it on. So we are just giving it back. They aren't acting like a wild tech startup anymore. They are operating like a massive, ultra-safe utility company. Here's the ultimate lesson. Apple isn't broken. The stock isn't failing. What's broken is our expectation that the $4.45 trillion company or more can double in size forever. The basic laws of math and economics always win in the end. Warren Buffett faced this exact same war with Berkshire Hathaway decades ago. He openly told his shareholders, "Our size has become an anchor to our performance." Microsoft is running into the same war today. Nvidia will hit it eventually too. When you get to the top of the mountain, we stop looking for potential. Wall Street stops paying for potential. They start treating you like a mature staple of the economy. The era of Apple as a high-flying, explosive growth stock is over. We are now at the maintenance era. Welcome to the maintenance era. If you hold Apple stock today, you aren't waiting for a 50% surge next month. You hold it because it's a fortress. It gives you stability. It pays a dividend, eats its own shares, and prints cash faster than almost any entity on earth. It's predictable, it's steady, and in a volatile world, boring is actually pretty valuable. Apple didn't lose the game, they've just finished it. If this breakdown gave you a fresh perspective, hit that subscribe button, leave a comment with your thoughts on Apple's subscription plan, and I'll see you in the next video.